All right, here's a riddle for you. What company lost $21 billion in revenue from a single drug and came out the other side growing faster than before?
That would be AbbVie. And honestly, the way they've pulled it off is one of the most impressive strategic pivots in pharma history.
We're talking about a company that had more than 40% of its revenue tied to one product, Humira, the best-selling drug of all time. Biosimilars hit, the revenue cratered, and Wall Street basically wrote the obituary. But the funeral never happened.
Not even close. AbbVie's replacement drugs, Skyrizi and Rinvoq, just posted $25.8 billion in combined sales for 2025. That's $4.5 billion more than Humira ever made in a single year at its peak.
So today on Charged Alpha, we're ripping open the hood on AbbVie, the company that turned a patent cliff into a launch pad. Let's get into it. AbbVie was born in January 2013 when Abbott Laboratories decided to split in two. One half kept the medical devices and diagnostics. The other, AbbVie, got the pharmaceutical business, headlined by Humira.
And from day one, the clock was ticking. Everyone knew Humira's patents would eventually expire, and the question was whether AbbVie could find something to replace it. The answer turned out to be not one drug, but an entire portfolio.
Today, AbbVie is the fourth largest pharmaceutical company on the planet by revenue. $61.2 billion in 2025 sales, up nearly 9% year over year. They're headquartered in North Chicago, Illinois, with about 57,000 employees worldwide.
The business breaks down into four main pillars. Immunology is the growth engine. That's Skyrizi for psoriasis and inflammatory bowel disease, and Rinvoq for rheumatoid arthritis and a growing list of autoimmune conditions. Then you've got neuroscience, which includes Botox therapeutic and is guided to $12.5 billion in 2026. Eye care and oncology round out the portfolio.
And a lot of that diversification came from one massive bet, the $63 billion Allergan acquisition in 2020. That deal brought in Botox, Juvederm, and an entire aesthetics and neuroscience franchise that now gives AbbVie revenue streams completely outside of immunology.
The moat here is real. AbbVie has first-mover advantage across multiple autoimmune indications, deep physician relationships built over decades with Humira, and a pipeline with over 375 active projects backed by $10.8 billion in annual R&D spending. Add in 52 consecutive years of dividend increases, and you're looking at a company that blends growth with income in a way very few pharma names can match.
At the helm is Robert Michael, who stepped into the CEO role in 2023 and was elevated to chairman of the board in February 2025. This is a guy who's been in pharma for over 32 years, started in Abbott's financial development program, and worked his way through every major function.
CFO in 2018, Vice Chairman of Finance and Commercial Operations in 2021, then President in 2022 before getting the top job. He was the financial architect behind the Allergan integration, so he knows exactly where every dollar goes in this company. Wall Street sees him as a steady executor, not a flashy disruptor, but the right person to navigate a complex transition. AbbVie stock is up 23% year-to-date under his watch, and his 2024 compensation of $32.5 million reflects the board's confidence.
All right, Lana, let's talk numbers. And I think the first thing people see when they look at AbbVie's valuation is the trailing PE ratio, 96 times earnings. That looks terrifying.
It does, until you understand why. That trailing number is inflated by one-time charges, including a $744 million IPR&D write-down AbbVie just took in Q1 2026 related to pipeline acquisitions. The forward PE is a much more reasonable 15.7 times, which is actually cheap for a company growing revenue at 9.5% with 38% operating margins.
And the PEG ratio is 0.91.
Right? Which means you're getting that growth at a discount to the earnings growth rate. The price-to-sales ratio sits at 5.4 times, and the EV to EBITDA is 15.6. None of those scream overvalued for a large-cap pharma name with this kind of momentum.
On the top line, full-year 2025 revenue came in at $61.2 billion, up 8.6% from 2024, and they're guiding 2026 to $67 billion, another 9.5% growth.
The quarterly trajectory tells the story. Q4 2025 revenue hit $16.6 billion, up 10% year over year, and that's with Humira still declining. Skyrizi alone did $17.6 billion for the full year, up 32%. Rinvoq added $8.3 billion, up nearly 30%. Together, they're projected to hit $31.5 billion in 2026.
What about profitability?
Adjusted gross margins are holding at 83.6%, which is elite. Adjusted operating margins expand to 38.3% in Q4 2025. Adjusted EPS for full year 2025 was $14.57, and guidance for 2026 is $13.96 to $14.16 after the IPR&D charge adjustment.
Cash flow picture?
Operating cash flow was approximately $19 billion in 2025, with free cash flow at $17.8 billion. That's the fuel for everything: the dividend, debt repayment, and pipeline investment. AbbVie is guiding free cash flow of $18.5 billion for 2026. The balance sheet is the one area that gives investors pause. Total debt stands at $67.1 billion, most of it from the Allergan acquisition. Cash on hand is $5.2 billion. The debt-to-equity ratio is 20 times, and the current ratio is below 1.
That sounds rough.
It's elevated, no question, but interest coverage is 5.2 times. AbbVie generates more than enough EBIT to service the debt. And with $17+ billion in annual free cash flow, they're actively deleveraging. Management targets a 2 times net to EBITDA ratio by year-end 2026. Overall, AbbVie's financial health is solid. The growth engine is firing, margins are expanding, and cash flow comfortably supports both the debt load and the dividend. The balance sheet leverage is the main risk factor, but it's being managed.
So what does Wall Street make of all this? The consensus rating is moderate buy, with 21 analysts at buy, 8 at hold, and just 1 lonely sell.
The average price target is around $253, with a range from $184 on the low end to $299 on the high end. That implies about 21% upside from current levels around $209.
Any notable calls?
JP Morgan just came out in early April with an overweight rating and a 260 target, calling the recent sell-off a buying opportunity amid competitive concerns from J&J's new Icotide drug. Scotiabank has a buy with a 280 target. They're bullish on the Skyrizi and Rinvoq ramp. Wells Fargo is overweight as well, saying the pipeline catalysts are underappreciated by the market.
And the last earnings report?
Q4 2025 results dropped on February 4th. AbbVie beat on both lines, EPS of $271 versus the $265 consensus, and revenue of $16.6 billion versus $16.4 expected. Management raised full-year guidance at the time, though they subsequently adjusted it down modestly after the $744 million charge in Q1. The next earnings report is April 29th, and that's going to be the big one. Investors want to see whether Skyrizi and Rinvoq growth rates are holding up.
Let's lay out the bull case. Number 1, the Humira replacement is the single most successful patent cliff transition in pharmaceutical history. Skyrizi and Rinvoq combined for $25.8 billion in 2025 and are projected at $31.5 billion in 2026. They've already surpassed peak Humira revenue by $4.5 billion. The replacement thesis isn't a hope, it's a done deal.
Number 2, the Allergan diversification is paying off. Neuroscience is guided to $12.5 billion in 2026, growing 16%. Botox therapeutic alone is a cash machine with high single-digit growth. This isn't a one-trick immunology pony anymore. AbbVie has multiple levers to pull.
And number 3, the pipeline has real near-term catalysts. Tavapadon for Parkinson's disease has an FDA decision expected in Q3 2026, and if approved, analysts see it as a $1 billion-plus peak sales opportunity. Rinvoq is filing for label expansions in vitiligo, alopecia areata, and hidradenitis suppurativa. Skyrizi just posted strong Phase 3 data in Crohn's disease with 55% remission versus 30% on placebo. The next wave of growth drivers is already in motion.
Now the bear case. Number 1, Humira isn't done declining. Projected 2026 sales are just $2.9 billion, down from the $21 billion peak. That's still almost $3 billion in revenue that's eroding. And if Skyrizi or Rinvoq growth slows even slightly, the math gets tighter.
What's number 2?
The balance sheet. $67 billion in total debt, a debt-to-equity ratio of 20 times, and a current ratio below 1. AbbVie borrowed heavily to buy Allergan, and while they're deleveraging, the leverage is still elevated. If interest rates stay high, refinancing becomes more expensive. Any earnings miss could spook creditors.
And the third bear argument.
Patent risk on the next generation. Skyrizi's core patents extend through the early 2030s, but that's closer than it sounds. Rinvoq faces similar timelines. Meanwhile, competition is intensifying. Sanofi's dupilumab is grabbing share in atopic dermatitis, and J&J just got Icotide approved as an oral psoriasis treatment. If efficacy parity emerges, AbbVie's pricing power could erode faster than the market expects.
Let's stack AbbVie up against the big pharma peers. We've got J&J, Merck, and Eli Lilly in the ring.
Johnson & Johnson is the giant, $581 billion market cap, trading at about 22 times earnings. But growth is in the low single digits. It's the safest play, not the fastest. Merck is interesting because they face a similar challenge. Keytruda's patent cliff is approaching in 2028, and revenue growth has slowed to 1 or 2%. They offer a higher yield at 3.6%, but the growth profile is weaker than AbbVie's.
And then there's Lilly.
Lilly is in a completely different lane. GLP-1 drugs, Mounjaro and Zepbound, are driving 30+% revenue growth, but you're paying 45 times earnings and getting a dividend yield of just 0.67%. Lilly is a pure growth play. AbbVie is the hybrid. 9.5% growth, 3% yield, 15 times forward earnings. For investors who want both income and growth without paying the Lilly premium, AbbVie sits in a sweet spot.
The options market is telling an interesting story right now. The put-to-call ratio is sitting at 0.42, which tilts heavily toward calls.
And implied volatility is at the 6th percentile. That's 1.6 standard deviations below the one-year mean. Options on AbbVie are historically cheap right now. Call open interest is clustering at the 220, 240, and 250 strikes, while put protection is concentrated at 190 and 200. Heading into April 29th earnings, the low IV environment could present opportunities for directional traders, but of course that cuts both ways if the move is larger than expected.
On the insider front, the picture is pretty one-sided. 0 buys and 8 sells over the past 12 months.
In March 2026, SVP and Controller David Perdue sold over 5,000 shares at $233. Throughout 2025, multiple C-suite executives, including the COO, CFO, and Chief Commercial Officer, were selling. Now, this looks bearish on the surface, but context matters. The stock rallied 23% year-to-date before the recent pullback, so a lot of this is likely diversification and tax planning. Still, 0 insider buys is worth noting. We'd like to see at least some executive conviction through open market purchases.
So what should investors keep their eyes on?
3 things. First, the April 29th earnings report. The market needs to see Skyrizi and Rinvoq organic growth rates holding above 20%. Any deceleration will trigger a sell-off. Second, the tavapadon FDA decision expected in Q3 2026. This is a binary event. Approval opens a billion-dollar Parkinson's market. Rejection sets the pipeline narrative back. And third, competitive dynamics. J&J's Icotide is the first real oral threat to Skyrizi's dominance in psoriasis. If market share data starts shifting, the premium AbbVie commands for its immunology franchise could compress.
So here's where we land. AbbVie has pulled off what many thought was impossible, replacing the best-selling drug in pharmaceutical history and actually coming out growing faster.
At 15.7 times forward earnings with 9.5% revenue growth, a 3% dividend yield, and a 52-year streak of dividend increases, this is a rare blend of value, income, and growth in large-cap pharma. The balance sheet leverage is the main overhang, but $17+ billion in free cash flow gives management the tools to address it.
The metric to watch is that Skyrizi plus Rinvoq combined growth rate. As long as those 2 drugs are compounding above 20% annually, the AbbVie thesis holds.
And here's one to keep in your back pocket. Robert Michael said it well. AbbVie's mission is to make a remarkable impact for the patients we serve through our innovative medicines. What's remarkable is that the financial results are actually backing up the mission statement right now. That doesn't always happen in pharma.
That is a great note to end on. That's going to do it for episode 73 of Charged Alpha, our deep dive into AbbVie, ticker ABBV. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.